So that's letter J. And I want you to make entries for 1, 2, 3, and then 4, and then 5, and then 6. I would want that, but let me have that already here. But I'm not going to upload that immediately. Okay? So I'm gonna cut this video here. So, in the last episode, I told you that you have to make a journal entry from 1, 2, 3, 4, 5, and 6. Okay? Now, what are the entries for this? First one, number 1. If you still remembered, you have paid in advance a rent for 5 months worth 15,000. That's in transaction letter C. Here. But then again, according to here, 2 months has already expired, and it is very much clear here that there is a rent of 3,000 per month. So times 2 months, that's 6,000. That will be recorded as the prepaid rent will be deducted. Prepaid rent. 6,000. Because you have to put that in the rent expense account. How much? 6,000. Okay? So that's the entry for number 1. How about number 2? It said that the supplies on hand is only 3,500. And if you have remembered, we have this entry where we purchased 20,000 worth of supplies. Okay? So 3,500 is the supplies on hand. That means 16,500 has already been used. So the entry related to that, letter D, or number 2 here, is just debit supplies expense because it has been used. 16,500. And then the credit is of course supplies. 16,500. How about number 3? So pardon me if I cannot erase everything. So I'll erase the letter A first here, so that I could put on the entries for number 3. So number 3, office equipment's life is 5 years and the salvage value is 500. So this is our computation for the depreciation expense because 2 months have already passed, so your office equipment is not already fully new. So meaning some of its life has expired. Okay? So what will we do? Again, from the brand new 30,000, since it could be salvaged after it is destroyed, after its life, for 500 pesos. That means the depreciable amount or the amount that could be decreased by using it is 29,500. So what is that? That's the depreciable amount. Again, historical cost, which is the 30,000, minus the salvage value. That's the depreciable cost or depreciable amount. Okay? And after that, you have to divide it by the life of the office equipment. And you will get the depreciation per year. So this should be the expense every year of use. But then again, there is a twist in this problem. It is because the office equipment has been purchased in November, right? So that means November to December, because December 31 is the making of the financial statements normally for those companies who are following the calendar year period. So every December 31, they're going to make financial statements. So 2 months has only expired. So meaning we cannot use this 5,900. We have to multiply it with times 2 months over 12 months. And you will get, I guess, if I'm not mistaken, I forgot. Let me calculate it first. 59 times 2 divided by 12, you have 983.33. And that is what do we call as the depreciation expense. So, how will you make an entry out of it? So, there is a twist in this one, in this number 3. So, number 3, your entry will be, it's very sure that there is a debit depreciation expense, or the expense because of using the office equipment worth 983.33. Okay? How about the credit? Of course, supposedly, the credit is the office equipment. However, however, in accounting, in bookkeeping, there's a twist because the office equipment, if we're going to always diminish it by the depreciation, we will not know already what is the original cost of the office equipment. So, for example, on December 31, if you deduct 983.33 from it, then it will become 29,000 plus only. Right? So, in order to preserve the records as to how much is that originally, what we are going to use as an account is the accumulated depreciation office equipment. So instead of this, you have to you have to erase that. You have accumulated depreciation office equipment 983.33. So what will happen? The office equipment will not be diminished. Instead, there will be an office equipment 30,000 and the accumulated depreciation will still be deducted from it 983.33 to get the book value of the office equipment, which is 29,000 plus. So this has been preserved. However, this accumulated depreciation has been made in order uh, to preserve this office equipment account of 30,000. But then again, it does not destroy the credibility of the financial statements because the book value will still be the same. It should be 29,000 plus only. Okay? So this accumulated depreciation that was used, which was deducted from the office equipment, is what do we call as contra asset account. It's an asset account. It will follow the office equipment. However, that is a contra account of office equipment. That is why that is considered as contra asset account. Do you follow? So aside from assets, there are contra assets accounts. Sometimes there are contra liabilities. And that's what's special about this number 3. Okay? Let's go to number 4. So number 4, let me erase this. On the number 4 entry, we have salaries incurred. That means your employees have already rendered their services, but you have not paid them. So what will happen is that even if you have not yet paid them, so long as you have already exhausted the benefits, you recognize that one as an expense. Salaries, expense. How much? That's again 3,000. And then you put their salaries payable. It's very logical, right? Because if you can still remember what we did with the A is equal to L plus C and the amounts, you can see there that the liabilities increased. Actually, that's salaries payable in our imaginary chart of accounts. Okay? So that's salaries payable. And then we have number 5, services billed but unpaid is 5,000. So that means when you bill your services, that means you have already performed your part. And if that will be the case, according to the accrual concept, you have to record already service revenues if you have done your part, even if you have not yet collected it from your customer. Service revenue, and then we have accounts receivable as an asset. How much is that? 5,000. I'm sorry. I copied the amount from the previous number for transaction. And we have number 6, 1 month of advance payment from clients in letter H. So these 3 clients have paid 80,000. So the letter H is here. You have received cash but you don't deserve it yet. That is why that is in the unearned revenue. So 80,000 divided by 5 months, that's 16,000 per month. So 1 month of advance payments from clients in letter H has already been earned because they have paid in 12/1, 20x2, and today we're going to assume that's it's already 12/31, 20x2. So what will happen is that your unearned revenue here, which has a credit normal balance, will be decreased. It will be debited for an amount of 16,000. Okay? Because you have to credit the 16,000 to service revenue. Okay? So, those are the entries. And I guess, because we have completed the entries, of course, we are now ready for the next step, which is the classification phase. So, this is already the step 3. Because I've said accounting is all about identifying the transactions and then measuring them and then of course recording them and then some, yeah, it's recording and then classifying. So step 3 is classification of transactions and we're going to do that after this.